From our Stars and Dogs segment, it's time for this week's Star.
Star of the week, which is Caledonia Mining Corp, CMCL, on the New York Stock Exchange. So the stock gained approximately 19% in the last week and is up about 75% in the past 6 months, where it now trades at about $16.60 at the end of today, with a market cap of about $280 million and a dividend yield just under 4%. So Caledonia Mining is a gold producer with its primary asset, the Blanket Mine in Zimbabwe, which has an 11-year life of mine. We originally recommended Caledonia in December of 2021 at $11.12 because of its cash-rich balance sheet. It has paid a nice 5% dividend yield and has a runway of growth following the sinking of its new central shaft at the Blanket Mine, which boosted gold production from 67,000 ounces in 2021 to about 80,700 ounces of gold in 2022. So we saw that growth coming there. Plus, Caledonia remains on the path to become a multi-asset gold producer in Zimbabwe, completing the transaction of the Bilboes Gold Project in January of 2023, which has a vendor feasibility study indicating the potential for an open pit gold mine producing an average of 168,000 ounces of gold per year over a 10-year life of mine. And Caledonia is now in the process of putting together its own feasibility study before it commences the full mine, but has started the preliminary oxide project, which entails the stripping of overburden. Now, the company also has the Motapa Gold Project, which is adjacent to the Bilboes Project in November of 2022. And they also recently completed an updated mineral resource estimate at one of their other projects, the Malagreen Project. So, driving the share price gain is, number one, the business's strong financial performance, releasing consolidated fiscal 2023 guidance, which represents growth of 14% in gold ounces over fiscal 2022. Number two, the fact that the business is on the path to become a multi-asset gold producer, even though this does increase operational risk in the near to mid-term. And of course, you cannot leave it out. Number three, the price of gold has been on a rally in recent months, driven by fears of the overall economy and banking contagion, with gold up around 8% in the last month and up about 19% over the past 6 months. And just looking at this chart here that I'm showing, just look at how correlated Caledonia stock is in relation to the price of gold. Orange here is the price of gold in US dollars, and the blue is Caledonia stock chart here. So Caledonia is not a Boyd or an Expel, which can grow sustainably over the long term. And we tread lightly in these types of stories, such as Caledonia, as if Caledonia's management team does everything right and the price of gold moves lower, the stock will likely perform poorly. So we do expect the stock to remain volatile. Now, we did recently update Caledonia for clients, giving them our thoughts on the business going forward. We provided a fair value sensitivity table in relation to the price of gold and indicated that, generally speaking, while you're up in a cyclical business, it may not be a bad idea to take some profit. That's it. That's all.
Yeah, I think it's a good summary. You can see how it, strikingly tracks the price of gold over time.
Yeah.
Most of the juniors, producers do, intermediate producers, large producers all tend to, track it over time. There's leverage to it, in some of the businesses, like the smaller companies as well. But, like Brennan said, the point that we always make is, a company like that, Caledonia, executed very well last year. If the price of gold, and there was one point in the price of gold was down significantly, over a 3-4 month period over last year, Caledonia shares go lower, even if management is executing significantly well. It takes the management team to execute very well and the price of gold to move with them, essentially, for you to see those gains. So you've got two levels that you have to attain for that company to do well over time. Now, this company checked off both those boxes. Well, they checked off the box of their execution well, and then gold moved for them. And then you've seen a significant rally in the share price, which is great to see for our clients. But you need those two things. And that is why we do tread lightly in those areas, because you can do all the research in the world, and the price of the underlying commodity, whether it's a steel-based business, a copper business, an oil and gas business, whichever it is, you can do poorly even if the company executes well. So, in another business, like Brennan brought up Boyd, if management executes well and they grow earnings and the share price over time, you know, you typically do very well in the stock. Um, with a gold company too, you have market risk as well, like to overlay over top of that. Gold can be doing well, but if the overall market is just in the toilet, then you have that risk that you have with every other stock, right? You're probably not going to, even if the gold price stays steady, you're probably not going to have the tremendous gains that you would if the market was doing well or just staying flat. So you have those risks as well that you look at in these companies. And that's why it is hard to be a long-term 5, 10, 20-year investor in a name like this.
Yes.
You can see an opportunity, you can capitalize on that, but it's a smaller percentage of your portfolio when we're looking at this relative to a Boyd, to a Brookfield Infrastructure, to some of the solid longer-term names, even the growthy-oriented names that we're looking at, that we can forecast 2, 3, 4, 5 years out and see a sustainable growth path ahead of them. So it's just important to point that out and bring it into and contextualize it when you're looking at an investment in a stock like this. You are looking likely at a shorter term horizon, which is far more risky than looking at a long-term play.
Yeah, and I just wanted to, toot our horn really quick here is, the price sensitivity chart that we did have.
Oh, don't do that, Brennan.
No, I would like to, because the price sensitivity chart that we did, or the price target sensitivity analysis that we did in relation to the price of gold, by projecting a $2,000 price of gold, which we are just underneath right now, I guess we're basically 10 cents or about 20 cents off of our price target, which we estimated. So,
which it's traded at in today.
Yes, which
is within the intraday trading.
Exactly, which it has traded at today. So, again, it's you got to keep in mind that commodity price and how it can affect the business, because the opposite is true. Is if we see $1,700 gold. We also got a price.
Yeah, if by the end of the year you see 1,700 gold, if CMCL executes tremendously well again this year, the share price, I would bet, is likely lower by the end of the year. So that is your risk right there, quantified. You can look at it easily. The management can execute. Company can keep paying their dividend. They can up their dividend. They can bring along their next project at a faster rate, less capital outlay, and the price of gold moves down 10, 20% over the course of this year, the share price will be lower.
Yep.
That is likely not the case in a business that doesn't have that exposure to the cyclical underlying commodity. Yes. So hopefully that illustrates what we're talking about when we look at it. There's an opportunity here. We take advantage of it. It's not bad in some situations when you're looking at a commodity-based business to take a profit when you've made a significant gain.